All right, welcome to The Explainer. Today, we're digging into something huge, a fundamental shift in our global economy. I mean, what if the entire system that's been running the world for the last 80 years is, well, about to break?
So let's just dive right in with a question that honestly challenges everything we think we know. What if our entire economy is built for a future that simply can't exist?
Okay, so check this out. On one side, you have the system we're all living in. It needs more people, more jobs, more income just to keep the lights on. But then, on the other side, you have the future we're all sprinting towards, an AI-powered world with fewer workers and way more automation. You see the problem, right? These two ideas, they just can't both be true. They're on a collision course. So here's how we're going to break this down today. First, we'll look at the great economic paradox. Then, the world built on debt we're all a part of. We'll get into the two major forces of disruption, what happens when the system starts to shake, and then the big one, what actually backs the future. All right, first up, our world built on debt. To really get what's happening, we have to understand the rule book the global economy has been playing by for, well, the last 80 years. And it all boils down to a pretty simple idea. You borrow from the future to grow today. So, at its very core, it is a debt-based system. Think of it like a machine that needs three specific types of fuel to run smoothly. You need cheap money, meaning low interest rates. You need population growth, which means more workers and more consumers. And you need slow and steady inflation, right around that 2% sweet spot. And that first ingredient, cheap money, is absolutely crucial because it leads to something called leverage. And look, don't let the fancy word throw you. Leverage is just using borrowed money to try and make even more money. I mean, think about it. If borrowing is cheap, it makes a ton of sense, right? Why wouldn't you? And this is not some niche Wall Street thing. It is literally everywhere. You've got companies borrowing cash to buy back their own stock, which pumps up the price. You have investors borrowing to snap up more assets. And of course, you've got governments borrowing to fund, well, everything. The entire system becomes dependent on this constant cycle of debt. Okay, so that's the system we've had for decades. But what happens when those core assumptions start to crumble? Because right now, there are two massive, disruptive forces that are challenging this 80-year-old setup. Force number one, the rise of AI. This one is a direct hit on that core assumption we just talked about, the one that says we'll always have more human workers earning more income to pay off all that debt. And look, this isn't some sci-fi future we're talking about. It's already starting to happen. The job market is showing some serious cracks. Just look at January. Over 108,000 job cuts were announced. That's the highest number for a January since all the way back in 2009. And this is before AI has really even hit its stride. And what's really wild is the timeline. The people actually building this tech, like the CEO of Anthropic, are saying this isn't 10 or 20 years away. We're talking 1 to 5 years for a huge disruption in white-collar jobs. So I have to ask, if half of those jobs get automated, what happens to that more income pillar that our entire system is standing on? All right, so that's AI. The second major force is geopolitical uncertainty, the predictable, kind of stable world order that made all this global leverage and borrowing feel safe. Well, it's starting to fracture. You know, for decades, there was this rules-based order. Everyone kind of knew how things worked. But that's fraying now. Trust in the US dollar is being questioned, trade and sanctions are being used as weapons. You see new supply chains and new alliances forming all over the place. All of this uncertainty is poison for a financial system that's built on predictability. So let's talk about what happens when the system starts to shake. You take these two forces, AI disruption and geopolitical fracturing, and you throw them into a global economy that's already leveraged to the max. What do you get? A recipe for some major volatility. It creates something called a deleveraging cascade. See, when things get uncertain, holding a bunch of debt or leverage suddenly feels incredibly risky. So what happens? Investors start selling assets to get cash and cover their debts. But that selling pushes prices down, which makes other leveraged investors nervous, so they start selling. It's a domino effect, a cascade. And what we experience on the outside are those wild, stomach-churning swings in the market. And a really interesting symptom of all this stress is a disconnect between a real physical asset and all the paper claims on it. This is often called synthetic supply. It sounds complicated, but it just means there are way, way more promises and bets on an asset than the actual thing itself. Okay, the best way to understand this is with a simple analogy. Let's talk about a Pikachu card. Imagine there is only one super rare Pikachu card in the entire world. That's the real asset.
Now, Wall Street comes along and securitizes it. They create an ETF, basically letting people trade tiny shares of the card without ever touching it. Then come the derivatives, futures, options, all these complex bets on where the card's price will go in the future. So what's the result? You still only have one physical card, but now you might have dozens, even hundreds of financial paper claims all tied to it. The paper supply has ballooned, while the real supply is still just one.
And this isn't just a funny thought experiment with a Pokemon card. We see these price discrepancies in the real world. A perfect example is silver. You can often see a premium for physical deliverable silver on the Shanghai exchange compared to the price of paper silver contracts on the COMEX here in the US. That difference tells you something important. The market is starting to get nervous, and it's putting a higher value on having the actual physical metal in your hand versus just a paper promise. So this all leads us to the final and maybe most important part of this whole puzzle. When the system is this shaky, what actually backs the future? What do you run to when things get weird? I mean, think about it. In a world where global alliances are fracturing and the very system we've known is facing this paradox, what is real money? What do you trust to hold its value? Well, the immediate reaction is what you'd expect, a flight to safety. You can see it here. Money starts to pull out of the really speculative, high-risk stuff. And where does it go? It flows into things that feel solid and dependable, like consumer staples and blue-chip stocks. You know, the boring companies that have been around forever and pay a dividend.
But the argument here is that in the long term, things that are protected from that synthetic paper supply become more valuable. As Andrei Jik puts it, you can't control Bitcoin's price with synthetic supply forever. The only way to truly break the system of paper claims is to, and I love this, take the card out of the system. In other words, you have to own the actual asset yourself, whether it's the physical silver bar or the self-custodied Bitcoin. You take possession of the real thing.
And that leaves us right back where we started, with this one massive, unresolved question. You have a system that is fundamentally built on human work, colliding head-on with a technological future built on machine productivity. When those two things smash into each other, which one breaks first?